Hi, this is Chuck Carnevale, and with this video I'm going to take a deep valuation look at Broadcom Limited, stock symbol AVGO. I'm going to look at three primary metrics with this video. Valuation is a puzzle, and like all puzzles, you have to put all the pieces together in order to paint the proper picture. So with this video, I'm going to look at adjusted operating earnings, which I currently have on the graph. I'll also be looking at free cash flow. And then finally, I'm going to look at Broadcom from the perspective of EBITDA per share. As you look at this video, the first thing that should strike you is how fast this company has grown. I'm looking at operating earnings going back to fiscal year 2009, where the company earned 66 cents. And one of the most important lines on this video is this change per year column. I want you to notice this is the earnings growth rate from one year to the next listed here. And as you can see, there are two really aberrant years here, 2009 and 2010. So I'm going to cut 2 years off of this graph, and I want you to notice that the earnings growth rate, operating earnings growth rate, has fallen to 27.8%. It's very important when you're analyzing data like this to be cognizant of what you're looking at. If I take another year off the 50% growth rate, you see that growth rate further falls to 25.2%. And when I'm using a high rate of growth like this, I'm drawing this orange valuation reference line with a PE ratio that's equal to the growth rate. So if I go back to the all graph, I want you to notice that in this iteration, the PE ratio that the line is drawing with is 45. If I shorten the time frame, that PE ratio changes. And that's really important when you're trying to ascertain valuation as you're looking at the company longer term. I would also like to point out this growth rate calculation includes estimate data, which is marked by an E here for the fiscal years October 17, 18, and 19. And watch what happens if I scroll back to the last actual reported year, 2016, my growth rate becomes extraordinary. And here I have a very, very high PE ratio. So when you're looking at a high growth stock like this, especially in the technology sector, the valuation reference line drawn with such high PEs is probably not relevant. So next I'm going to add the normal PE ratio calculation. And what you're going to see here with Broadcom Limited is that the fact that the normal PE ratio for this company has been around 14.7. I'll add monthly closing stock prices, and you'll see that the stock price has very closely tracked that normal PE ratio of somewhere between 14 and 16. I always like to think of these things in a term of a range. So from the standpoint of operating earnings, I consider this stock very attractively valued at this point. Next, I'm going to look at free cash flow, because what I haven't introduced yet, which I will in a second, is this is also a dividend growth stock in addition to being a high growth stock. But I want you to notice here that the cash flow growth, or free cash flow growth, has averaged over 37%. And when you're looking at Broadcom from the standpoint of free cash flow, we see the normal price to free cash flow in the 20 range. Here it's marked as 20.8, and you can see the stock price has followed that very closely. The reason this is important is because this is a dividend paying stock. So now I'm going to put the dividends utilizing this free cash flow metric, and you can see that the company's free cash flow more than covers the dividends. I also want you to notice that since they started paying a dividend, their dividend has grown at a very rapid rate, and I'll show you a little bit more on that a little later. So from a free cash flow perspective, the company is also very attractively valued at a multiple of about 20 times free cash flow. And finally, I'm going to take a look here at EBITDA per share. And when I look at EBITDA growth, I also see a very high rate of EBITDA growth. So here I've got a multiple of 12 times EBITDA here on the graph, because EBITDA obviously is earnings before interest, taxes, depreciation, and amortization, and you've got essentially a higher number here than you did with the other metrics. But I do want you to notice when looking at this graph how closely the price has correlated to this EBITDA. But the thing that's really striking from the perspective of whether this is a good investment or not when looking at EBITDA is the fact that there is a very high forecast growth rate of EBITDA going forward for this company. Now moving down to the forecasting calculators, I'm going to look at the consensus forecast for EBITDA on Broadcom. Now, one point that I think needs to be focused on is that there are not many analysts willing to make a forecast for EBITDA, but there are 3 analysts that are forecasting an 81% increase in EBITDA for fiscal year 2017, again, which ends in October. That's a very, very high growth rate. And looking at the historical correlation that we see with price and EBITDA, that would imply a very high rate of return going forward if the EBITDA forecast did come to fruition and the company traded at this normal multiple of EBITDA, which I have marked here at 12 times EBITDA. The orange line in this graph is 12 times EBITDA. Now, one thing that's very important when looking at forecasts, I'd like to go to the Analyst Scorecard. The record of forecasting 1-year and 2-year forward forecasts for this particular company has been extraordinary. The analysts have virtually hit it on the number in almost every case. The 1 year is the one I'm really focused on in this video. And the other thing I want you to notice here is not only has the company met analyst forecasts, it's actually exceeded it. You can go to other websites and see earnings reports, and you'll discover that this company has a history of exceeding analyst expectations. And here I'm looking at EBITDA. So in order to summarize what I've looked at so far, when I look at EBITDA, the company is trading at about a 11.5 EBITDA, which is historically normal, which would indicate sound valuation when you're looking at it from the perspective of EBITDA. If I go back to adjusted operating earnings, we see that the normal PE ratio on adjusted operating earnings has been somewhere between 14 and 15, and the company is trading at an operating earnings PE of 15.4. It's well within the sound valuation range there. And then finally, if I look at it from the function of free cash flow, which is very important when you're looking at dividend coverage, you'll see that the company is trading right within a very close proximity to its normal price to free cash flow range, about 21. So all in all, when you look at these various metrics, I consider this company attractively valued based on EBITDA, operating earnings, and free cash flow. But from a standpoint of its dividend, I would like to move to that now. I think there's some very important aspects here that need to be considered as well. First of all, I would like you to notice that the company's payout ratio of free cash flow is very low, and another way of saying that is free cash flow is significantly covering their dividend. And as I'll show you in a moment, this company generates a lot of cash, operating cash as well as free cash. And as a result, I consider the dividend very solid. As I mentioned in the written part of this article, management is committed to continuing to raise their dividend at a very high rate. In looking at past performance, I'm going to go back to operating earnings here and look at the associated performance graph. The associated performance graph is calculating performance from, in this example, 8/31/2009 to yesterday's closing stock prices. And what's really extraordinary about this company's performance, as I mentioned in the article, it's a growth stock. And I'm using the standard $10,000 investment on 8/31/2009 at a price of $18.20, would have grown to $101,659. That's a 36.9% compound annual capital appreciation rate, which is very consistent with the operating earnings growth rate we saw above, considering that it trades at around a 14 or 15 normal price to earnings multiple. But I really want to take a look at the dividend growth here. As you can see, their dividend growth rate for this 5-year period has averaged 128%. The compound annual growth rate has been 87.9. On that $10,000 investment, your original yield would have started out at 0.4%, and for fiscal year 2016 ending in October, your yield would have increased to 13.8%. On a $10,000 investment, the company would have generated $1,384 of dividend income. When you compare all these results to the S&P 500, you first of all see that the company generated twice the cumulative dividend income than the S&P. And when you also consider that this has been an extraordinary time frame for the S&P 500, in other words, these are above average returns for the S&P, this company almost quadrupled their annualized capital appreciation rate. And then when you add in total dividend income, it's also 3 to 3.5 times greater than the 12.8% that the S&P earned. A $10,000 investment would have generated a total annualized rate of return of 37.6%. This is why I consider this company a growth stock. But as I also mentioned in the article, it's also a rarity in that it's also a pretty salty dividend growth stock as well. Next, I would like to take a look at some of the financial underlying numbers by going into fund graphs and taking a closer look at I'm going to start out by looking at some important balance sheet metrics, primarily long-term debt per share and total debt per share. And there's a couple of things about this. As I mentioned in the article, this company has grown through acquisitions. And there was a period of time when the company had virtually no debt on its balance sheet. But due to the recent mergers and acquisition activity that I mentioned in the article, and that Morningstar also commented on, the company has taken on some significant debt lately. But now I want to take a look at cash and cash equivalents, and I'm going to shorten this to look at the time frame here where they've taken on this additional debt. They just announced a $13.5 billion debt offering, and I'm going to talk about equity raise here in a minute also, but I also want you to look at cash per share, cash and equivalents per share in the balance sheet. The company does generate a lot of cash and a lot of cash flow, as I mentioned earlier, so management is committed to strengthening the balance sheet going forward as they digest these acquisitions. So debt is not something that I'm afraid of. The debt to capital ratio is still very low in this company. Next, I'd like to take a look at their equity structure a little bit. This company has primarily been issuing shares recently, and last year they did have quite a large capital raise by issuing, going from 276 million shares to 398 million shares. And I think, of course, that's in line with the acquisitions that the company has made that I discussed in the article. The final fundamental or financial underlying number I'd like to look at is their gross profit margin. The company has consistently generated gross profit margins in the 50 to 60% range. And when you look at the most recent quarters, this is going back to April of 2015, you'll see that that's a very consistent margin. They are committed with this new merger and the movement into Brocade in maintaining at least a 40% gross profit margin going forward. However, one thing I would point out as I show you this, their net profit margins have been under pressure as a result of these acquisitions and some of the charge-offs that come with that. But they're still generating plenty of gross margin, and I believe the net margin will soon follow. At this point, this video comes to an end. I would like to move on to their recent pending merger with Brocade Communication Systems. One of the things I pointed out in the article, when they announced this merger or acquisition, the valuation of this stock was very low. So I really like the idea that this company is disciplined in making all the many acquisitions and mergers that have evolved into the current company, and they seem to do it at a very prudent manner when they're making these acquisitions. So this will be the next addition coming into the Broadcom Limited stable. So to conclude this video, when you look at consensus estimates for operating earnings, you'll see that future rates of return based on operating earnings would be double digit, utilizing a normal PE ratio of around the 14 to 15 range. When looking at Broadcom from the free cash flow perspective, you notice this 20.1 normal price to cash flow ratio, 20.8. And when I look at the forecasting here, and I'll choose the as close as I can get, or actually that 20.8 multiple, if this company would actually generate this kind of free cash flow and generate those multiples, the rates of return going forward over the next couple of years would be extraordinary. And I do want to, again, take a look at the history of free cash flow estimates. On the 1 and 2 year free cash flow estimates, analysts have been right on the money when looking at this company. And then finally, if I take a look at it from a standpoint of EBITDA, I get more of the same. So as I put this valuation puzzle together here, I see a company that's potentially capable of generating really superior rates of return, offers a 2.2% current dividend yield. The stock was very strong yesterday, but I do believe there are significant growth prospects. I covered some of the risk of investing in this stock in the written part of this article. I do my homework and due diligence, but I think this company's worth a further look. This has been Chuck Carnevale saying thanks for listening.